Welcome to this section on fundamental analysis. We'll be delving into great detail into the exact mechanics of why and how the markets move and getting a deeper understanding of the things driving price both over the long and the short term. We'll begin by refreshing our memories on what we've already learned about fundamentals, namely that they are the reasons why the market moves. We'll also talk about how having a detailed understanding of the fundamentals can help you develop something called conviction and why this is also vital to your trading. As you probably remember, the fundamentals, particularly for FX, tend to revolve around the central bank of each nation and the market's expectation for what that bank will do next. The bank use economic indicators to determine the state of the economy and then implement certain tools that help them improve those indicators and keep everything stable in line with their mandate. In this section, we will expand on all of that so you'll have a comprehensive understanding of the whole process of analysing and understanding all the parts that make the fundamental analysis so potent to Forex trading. Now, to do this effectively, we have to break the concept of this analysis down into two distinct parts. The first part is the underlying fundamentals that we've already spoken quite a lot about during the institutional fundamental sections that you have looked at. But what we haven't really looked at too much is the things driving price in the here and the now, and this is called sentiment. So, we have two core elements that we must be in tune with at all times: the underlying fundamentals and the ever-changing sentiment. The simplest way to understand this is to imagine that the fundamentals are the big picture, things that, that don't change too often, that they're the ones driving price over weeks and months, while the sentiment are the short-term things that drive a price over like hours or days. Of course, sentiment can take over in the short term to move the price against the overall fundamental trend. But as long as the core principles remain in play, the trend will always resume at some point as the sentiment fades. Understanding these two concepts and how they work provides us with the foundations for identifying various trading opportunities throughout the trading day. For example, some traders use the short-term sentiment as opportunities to trade the longer-term trend at a much more attractive price, while other traders take advantage of the sentiment and trade in line with that in order to make a quick profit. The concepts that you will learn in this course will give you everything you need to identify the style of trading that fits your personality best, based on whether or not you prefer to day trade, as most of our professionals do, or position yourself for longer-term moves in line with those underlying fundamentals. As we've already seen, fundamentals are very important to successful trading, but there are four central areas to a successful trader that must all be honed if you're going to make it. And one of the core things that this study and learning will give you is something called conviction. Conviction simply means confidence, but traders use conviction to determine how good a possible trade is and how likely it is for that trade to win. If you have a very high conviction in a trade, based on all the things that you've learned in this program, along with your own individual research for that specific opportunity, then generally your chances of success are much higher. Traders that do not pay attention to their conviction levels, or that simply don't know how to gauge or even increase their conviction, have very little chance of success. You must constantly be aware of your conviction and, of course, understand how to measure and control it in order to achieve the levels of success that we are looking for. Now, with this in mind, researching the fundamentals surrounding a trade in both the underlying reasons and the short-term sentiment will directly influence your conviction in a position. So paying very close attention to the fundamentals is vital on multiple levels. Okay, so what we're going to look at next is the concept of intermarket analysis, which we focused quite heavily on during the Institutional Fundamentals course. The reason we looked at this at the very beginning of your training was because it's actually very important to understand these interrelationships and also to understand our own place in this process, of course, as speculators. Despite our sole intention of making a profit, we play a much more important role than is commonly thought, which of course is to provide the wider market liquidity and ultimately better prices to trade from. It bears repeating that without speculators like us, the global financial markets would grind to a complete halt almost overnight, causing industry, agriculture and businesses around the world to fail. So we need to take our positions seriously, but also prepare correctly if we're to participate profitably and successfully. Now, speculators contribute to all markets and generate movements across a broad range of asset classes. Over the next few minutes, we're going to take a look more deeply into these other markets being traded, how we can utilise this information to profit from these moves, and most importantly, how they are relevant to us as FX traders. In the Institutional Fundamentals course, we looked at the futures market and how this is the birthplace of modern day financial trading, and also how there can be a futures contract for almost any asset class that can be traded, including currencies. But what we're going to do here is look at some of those asset classes in more detail. The main ones that have specific relevance to FX are bonds, commodities, and equities. So let's start with bonds. Now, if you're interested in financial markets, you should have at least heard of a bond and have an outline of what they are. A bond is simply a form of loan. So you and I would borrow money from a bank or maybe even family. But for a very large company or a government, this is impossible because banks are not in a position to lend such vast sums of money safely while keeping their balance, the books balanced. So instead of these loans, these large entities, raise money by splitting that loan between thousands of investors on the open market. Anyone offering bonds to investors is called an issuer. In exchange for this investor money, the government or company will obviously pay the money back at a certain date, which is known as the maturity, and on top of this, they will also pay the investor some interest to make it worth their while. This interest payment is also called the coupon. Bonds are known as fixed income securities because the amount of money the investor will receive at the end of the loan is known in advance and guaranteed by the issuer. The coupon is paid twice a year, and then at the end of an agreed lending period, the investor receives their original investment back. So for example, if you buy a bond with a face value of £1,000 and it has a maturity of 10 years and a coupon of 8%, this means that you'll receive £80 every year for 10 years and then your original £1,000 back. When purchasing a bond, you're effectively purchasing debt. As we touched on very briefly, there are two main types of bond: the corporate bond, which companies issue, and government bonds, which are issued by nations trying to raise money for various social programs or infrastructure costs. Now, for our purposes, the most important type of bond is a government bond, because these are directly influenced by interest rates, which of course ties them in perfectly with FX trading. Now, because governments are very dependable and stable in most first world nations, the chances of them not paying the coupon or the original principal is obviously very low, making bonds a low risk investment. Now, because they are sold and traded on the open market, it means that you can buy a bond but also sell it to another investor at any time before the maturity date. Now, some people get confused about the price of bonds and the yield of the bonds. When pricing bonds, it's important to remember that the face value is the price that will be returned to the investor at maturity, and the price of the bond is how much it would cost an investor to buy it off another investor before that maturity date. When a bond is trading at a price above its face value, then it's said to be trading at a premium, whereas when it's trading below its face value, then it's said to be trading at a discount. The interest coupon can be based on a fixed interest rate that is tied to the face value. For example, if you buy a bond for £1,000 and have a fixed rate of 10%, you'll receive £100 each year no matter what happens in the markets. Or, as in the case of US Treasuries, it can be tied into fluctuating market interest rates through an index. The price of bonds with a lower coupon tend to fluctuate more, while the higher coupon bond prices tend to be a lot more stable. The maturity date can be anything from a day to 10 years, and sometimes it can be as high as 100 years, as in the case of Mexico in 2015, when they launched the world's first ever 100-year bond priced in euros. The length of the maturity will also dictate what price it is, because a bond with a 1-year maturity is also much more predictable than one that matures in 100 years. So in general, the longer the time to maturity, the higher the interest rate will be. Of course, this all revolves around risk, and the higher the risk, the higher the coupon will be. And to help investors navigate these risks, there exist several special bodies to alert investors to the highest and lowest risk entities out there. This helps the investor make correct decisions based on their own risk tolerance. The three biggest bodies or agencies are Moody's, Fitch, and S&P. And the market pays close attention to what these agencies say and how they relate each issuer. They have several rating levels which split each issuer into either investment grade or junk grade. Issuers with a multiple A rating are the highest quality ones to deal with, while BBB to single A ratings are still strong. Anything that has BBB rating or below are considered speculative and much higher risk. Now, governments and their bonds that are rated as junk are not necessarily safe and must offer a much higher yield in order to tempt investors in. Now, the most confusing part of the bond story for most new traders is seems to be so many different prices to measure. So we're going to go and simplify this and give you just as clear understanding as possible of how all this works. Now, when you are trading and reading articles and the news feeds, you'll very often hear analysts talking about something called the yield. The yield is simply the coupon amount divided by the price of the bond. To understand this better, we'll use an example to explain it. Now, to do this, of course, we're going to oversimplify it slightly, but it'll give you a good general idea. Now, imagine you buy a bond with a face value of £1,000 and a coupon of 10%. So if the price remains £1,000, then the yield is simply £100 per year. However, if the price of the bond goes down to 800, the yield now increases to 12.5% because the coupon payment is based on the 10% of the original face value of the bond. This means that you will be receiving £100 for an £800 bond, which is obviously better than 10%. The reverse is true, of course, if the price goes down. So it's due to this effect that when trying to simplify this relationship between the price of the bond and the yield of the bond, we can say that when the price goes up, the yield goes down, and vice versa. So if you're in the market for buying bonds, your primary concern is a high yield. But if you're a bond holder and you already have your yield locked in, you want to see the price of the bonds increase so you can have the option of cashing out for a much bigger profit later on. The primary thing we need to appreciate when thinking about bonds is the relationship with interest rates, because they're just as important to bond markets as they are to FX markets. Now, when interest rates rise, the price of bonds in the market fall, thereby raising the yield of older bonds to bring them into line with the new bonds that are being issued with higher coupons. When interest rates fall, the price of the bonds rise, therefore lowering the rate of older bonds, or the yield of the older bonds, and bringing them into line with newer bonds being issued with lower coupons. That's why bonds are so affected by rate adjustments and, not just that, but the speculation surrounding them. So there are three types of government bond. There are bills, which mature in less than 1 year. There are notes, which mature between 1 and 10 years, and bonds, which mature longer than 10 years. All of these marketable securities from the US government are collectively known as treasuries. So you have treasury bills, treasury notes, treasury bonds. US bonds are widely watched in the markets because they are regarded as the safest form of investment available, because they are issued directly by the US government. Other first world governments are also seen as being extremely safe, with the UK, for example, never defaulting in its debt in all of its long history on the global scene. Now, because of the secure nature of bonds and the fact that they provide a guaranteed payout, they're extremely popular with large investment and pension funds from around the world looking to ensure growth and income in the safest way possible. Bond markets relate to FX on two main levels. The first is their codependency on interest rate fluctuations and speculation, meaning that by watching the bond markets, we can sometimes get clues as to whether or not similar moves may happen in FX. The other correlation is due to the demand produced by attractive bond yields. So, for example, during times of increased risk or low domestic yields, large funds may decide to invest into the bonds of a foreign government. For example, a UK pension fund may well decide to buy some US treasuries in order to protect them from being overly exposed to UK assets. So to do this, they first need to buy US dollars, which means selling their British pounds in exchange. So by trading the bond market, they first must trade the FX market, effectively selling the pound-dollar pair. In very large volumes, this can obviously have a temporary impact on the price of various currencies, and as such, it's very important for us to be aware of it. Now, the next asset class that can impact currency markets is one you've definitely heard of, and that is of commodities. Now, commodities are raw products from nature that can be bought and sold. There are many different types of commodity being traded in the financial markets, from oil to gold to corn and milk and so on. Now, as with most markets, the bulk of trading volume comes from speculators who are simply betting on the price of the commodities going up or down. But as we previously looked at in the institutional fundamentals course, This activity provides genuine commodity traders much better prices at which to buy and sell the produce they require and ensure that the producers get a fair price, which enables them to make a profit from their work. Traders most commonly trade commodities via futures contracts, but can trade them via a host of other investments, including spot prices, options or ETFs. Now, if you're interested in the mechanics of how commodities can be traded, then there's an abundance of information freely available online on this topic. But our goal here is to introduce you to terms and concepts that you will be coming across time and again during your professional FX trading. Because there are so many different commodities and they're all traded individually from each other based on external factors such as supply and demand, the relationship between certain commodities and currencies is mainly based on how much of an impact the price movements on the commodities will impact the overall economic performance of the nation producing it or importing it. For example, we can take the Canadian dollar as an example of this. Now, Canada is a major producer of oil, and if the price of oil falls significantly over a sustained period of time, then eventually this will start to reduce the amount of money Canada makes on its oil and ultimately start adversely affecting figures such as GDP and growth in the country. If the economy stagnates and inflation starts falling, then the Bank of Canada may be forced to cut its interest rate, which in turn will cause the currency to devalue. So it's of great concern to traders holding Canadian dollars what is happening in the oil markets and the reasons why, so they can determine how much of an impact it will have on the future value of that currency. The key to understanding a correlation to commodity prices lies in two key areas. The first key is knowing which countries have a heavy dependency on either selling or buying commodities, and the second is being tuned into how much focus the market is giving to the moves on those commodities. The truth is that commodity prices move every day, but not all of these moves will impact FX, simply because they may not cause the market to have any fears or hopes about the longer term impact on the country's economy. If oil prices fall hard in a single session because of some announcement from OPEC, this may not necessarily cause any large moves on the Canadian dollar. However, if it moves in a strong trend and the market has a very good reason for this to continue, for example, what was an example is if there's an oversupply and the oil producing nations decide not to cut production and instead wait it out, then this could lead to more concern from the FX market, as the uncertainty of that type of situation could lead to panic selling, which could snowball if there also starts to be a negative data coming from Canada as a result. So the key really is not just to watch the commodity chart or try and trade a correlation simply because they happened in the past, but to tune into the market's reaction and gauge how serious the reasons for the move are being taken and what the expected impact could be on the nation's economy. The main reason traders get confused when trying to conduct intermarket analysis is that they try and interpret each move as a fixed rule. So if oil goes up, Canadian dollar must also go up, and so on. The reality is that most of the time the markets might not even bat an eyelid at oil prices. But then all of a sudden they become obsessed with it and the two become intensely correlated, until they forget all about it and move on to the next concern or hype. The market is people. People are fickle and sometimes, and very often in fact, irrational. So you should definitely keep an eye on commodities prices and how they relate to certain currencies, but most of your analysis should be news and sentiment based rather than purely price based for the best results. Now, another asset class that you will often hear about via news feeds and wires is of course equities, or stocks and shares. Equities are simply stocks or shares of companies from around the world. Traders use the stock market to gauge how well the market is expecting the economy of that particular nation to perform. So, if they're expecting the economy to do well, the growth to accelerate, then the stock market would generally rally and push higher, and vice versa. As with commodities, this is not an exact science, and most of the time FX markets will trade off their own issues, leaving stocks to move in their own way. But other times, they'll become obsessed with something happening in the equities market. For example, maybe there's a big sell-off on the stock market, and this creeps over to FX markets until there's an all-out panic, crashing both markets. This is exactly the type of scenario that tends to occur and bring both of these markets into the spotlight. Stocks can also be impacted by FX. For example, if a company has many sites around the world, then they will need the currency of each country in order to pay their staff in those places. These large transactions can have a very limited impact on currency prices in the short term. Also, if a central bank implements a sustained campaign of dovish behaviour, leading to the depreciation of its currency over a period of weeks or months, then this can impact the future earning potential of companies that export a lot of products abroad. The depreciation of the currency can give those companies a more competitive edge because the cost of their items is now much less and falling, potentially meaning a growth in profits and dividends, which leads to a higher share price. Now, as you can see, all markets are interrelated on many levels, and one does not always lead the other, and none of them are necessarily related at all. But when the market has a concern or an idea in its mind, the correlations can be very powerful and lead to some excellent trading opportunities. Now, the main point of this short section is to introduce you to the concept of intermarket analysis, but mainly to stop you from getting overly caught up in the rules of how each market is connected and mostly focused on using the market's reaction to tell you when you should be focused on a particular correlation.